You work 50+ hours a week, pay every bill, save a little, and then tax season arrives, and boom, thousands gone in seconds. Ever wonder how the rich keep more of their money while you keep donating yours to Ottawa? The truth is, Canada's tax system is not broken. It's built to reward those who understand it. And right now, a completely legal, CRA-approved strategy exists that most accountants never even mention, not because they can't, but because it's too advanced for the average client. Stick around. By the end of this video, you'll know exactly what this loophole is, how it works, and how to use it before it quietly disappears in 2026. Let's be real. Canadians are exhausted. Inflation's eaten our raises, interest rates doubled our mortgages, and every extra dollar seems to vanish into withholdings. You're doing everything right, yet the government keeps moving the goalposts. Meanwhile, you see corporations deferring billions through strategic reinvestments. Wealthy investors structure deals to pay tax years later, if ever. Here's the question. If they can legally delay or reduce their taxes, why can't you? The answer is, you can. You just need to understand two advanced structures that 99% of taxpayers never use. The capital gains reinvestment deferral. Selling an asset, but reinvesting fast enough to delay the tax hit. 2. The flow-through share deduction. Using the resource sector to legally shift deductions to yourself. The first one, capital gains deferral, isn't a loophole in the shady sense. It's actually part of the federal housing plan meant to push money into new construction. Here's the deal. If you sell a property or business asset and reinvest the proceeds into qualified rental housing within a specific window, you can defer the capital gains tax. Think of it like hitting pause on your tax bill. You're not escaping it. You're moving it to a later date, when your investment's producing cash flow that can pay the tax for you. The second one, flow through shares, is a hidden gem Canada invented decades ago to encourage exploration. Companies spend millions digging for minerals. Investors like you fund it, and in return, the company flows through its exploration expenses. Those expenses become tax deductions for you personally. Translation, you buy shares, get an immediate write-off, and sometimes an additional provincial credit. It's high risk, but incredibly efficient for anyone in a 35–50% bracket. Imagine you sold a secondary property and realized a $150,000 capital gain. Normally, half is taxable. $75,000 goes on your return. At a 40% marginal rate, that's roughly $30,000 straight to CRA. But let's say you reinvest into a new rental project that qualifies. That $30 K-tax? Deferred. You keep it compounding inside your asset. 10 years later, that money could grow to $48K and then you pay on your terms. Or picture you earn $200 K this year. You buy $40 K of flow-through shares in a qualified mining firm. Those shares let you deduct the same $40 K as exploration expenses. Your taxable income drops to $160 K. That single move can save you $14,000 to $18,000 in taxes, depending on your province. These are real numbers. These are real-world advantages. And they're perfectly legal. You're probably thinking, if this is legit, why hasn't my accountant told me? Simple. Most accountants are overloaded filing compliance work, T1s, T2s, payroll, GST. Their job is to keep you compliant, not wealthy. Advanced planning requires time, research, and liability they often can't bill for. Second, these strategies aren't one size fits all. They depend on your risk tolerance, asset type, and timing. So unless you bring it up, they'll default to the safe middle lane. That's why the wealthy always have tax strategists, not just preparers. They pay people to read budget notes, dig through CRA interpretation bulletins, and structure deals around incentives. Incentives meant for anyone willing to learn. Now let's clear the air. This isn't tax evasion. You're not hiding income or creating fake expenses. You're operating within the law's design. The CRA itself defines tax avoidance as arranging your affairs to pay the least tax within the rules. Only when it becomes abusive, when the main purpose is deception, does GAR, the General Anti-Avoidance Rule, kick in. So document everything: share purchase agreements, reinvestment timelines, proof of eligible expenses. Keep digital copies ready for audit review. If CRA ever challenges you, you're not guilty until they prove the structure's abusive. And with clear intent and paperwork, you're on solid ground. 1. Find a proactive accountant or tax lawyer. Ask if they work with FTS or capital deferral strategies. If they hesitate, find another. 2. Review your portfolio, any property, shares, or crypto you might sell in 2025. Note potential gains. 3. Build liquidity. When opportunities appear, new flow-through offerings or rental projects, you'll be ready. 4. Track government updates. The next federal budget or CRA bulletin can open or close windows fast. 5. Separate records. Keep tax strategy investments isolated from regular accounts. Simpler to prove intent and compliance later. Combine this with loss harvesting or RRSP top-ups for a triple effect. Example: defer your $30K gain, claim $40K flow-through deduction, then dump the refund into your RRSP. That refund earns its own deduction again next year. You've now turned one strategic year into multi-year compounding tax savings. The same cycle wealth families repeat quietly year after year. Listen, the game was never about working harder. It's about understanding the rules better than anyone else. The government literally rewards investors who create jobs, housing, and resource development, and penalizes passive earners who don't. You decide which side you're on. If you want me to break this down by province, Ontario, Alberta, BC, and show which credits stack best, comment blueprint below. I'll pick a few of you for personalized breakdowns in the next video. Smash that like button so YouTube knows Canadians still care about real financial freedom. Subscribe because Financial Mo is back and we're not playing safe anymore. Stay smart, stay compliant, and as always, keep your money working harder than you do.